Hunter, we are halfway through 2025. Markets have been all over the place, frankly. And today we are talking about our Q3 newsletter that just came out, kind of recapping the first part of the year, diving into what's happening next. I'm super excited. And what we titled our newsletter was Back to Regularly Scheduled Programming, because we've talked about this a lot, but it's exciting that we're finally starting to get back to normal markets again. What feels like, hey, let's look at fundamentals of companies. Let's pay attention to, what the economic data is telling us, rather than these extraneous events that have really dominated markets year to date. And so I'm looking forward to kind of discussing that today and just, following up with all that we've seen in the first half of the year and what we're looking forward to in the second half.
Yeah, exactly. I mean, markets in Q2 especially were crazy. All started in early April with Liberation Day and the infamous chart at this point of reciprocal tariffs. And we've really seen a, kind of a pretty solidly V-shaped recovery in asset prices coming off of that, really sharp dip of uncertainty. And we then slowly ticked higher as, there's been more talks, more come out, more developments in that story where, maybe not a V-shaped recovery, but more of a check mark recovery.
Yeah, definitely. And it has been interesting to see what investors were most concerned with in the early and kind of mid part of these first two quarters. What was all in focus has kind of started to fade to the background to some extent. And that's why I want to get into that with you on the podcast today. So really what we're going to be talking about for our audience is the quarter in review. So equities, fixed income, commodities, looking at those, what they've done year to date. Currency markets, we've seen a lot of movement with the US dollar. Going to dive into that a little bit. Interest rates and the Fed, always top of mind, considering, hey, when is the Fed going to cut rates? We're going to talk about the continued focus on trade deals, part of what we, talk about when we're talking about getting back to regularly scheduled programming. Geopolitics, of course, which is throwing a wrench in markets every once in a while these days. And finally, what we're watching in the second half of 2025. So we have a lot to cover on the podcast today, but I'm excited to dive into it.
Yeah, me too. So just taking a look back at kind of how equity markets have fared over this past quarter, like we mentioned, coming off of Liberation Day, markets really tanked for a while there. It is a rough few weeks. And then around, I think, April 8th was the bottom. April 11th, somewhere in there, was the absolute bottom. And we've charged back, come back even stronger, and are now sitting at all-time highs. Roughly thereabouts all-time highs in major indices. So it really goes to show kind of how much the market has been able to get over, the tariff implications and kind of look through all of that noise and really refocus on what we're all here for is earnings. Really, American exceptionalism has proved that it's not dead, that it is a continuing thing because earnings did come in pretty good.
Right. To that point exactly, S&P 500 company earnings were up 12.9% year over year this past quarter during earnings season. And that really just shows that companies are continuing to perform well. They're operating at a high level, still able to manage their costs in the amidst, what's kind of a precarious situation while also growing revenue substantially. And that growth in earnings is continuing to support valuations. So you hear a lot of market participants talk about, hey, valuations are on the higher side of the spectrum right now. Well, it's being justified by this earnings growth. If we continue to have double-digit earnings growth from the S&P 500, you can justify higher valuations and higher stock prices in the future. So I think first and foremost, that's what comes to mind to me is that corporations are still performing really well. Earnings season was a success. So if you're talking about getting back to regular programming, paying attention to company fundamentals, company earnings, that's a huge part of it. That's pretty much the biggest driver of stock prices at the end of the day, barring these extraneous events. So seeing that we had a good earnings season in the midst of what's kind of a crazy market environment was really positive.
Yeah, and just kind of drilling one step deeper, looking at the sector level, is technology was really a case study in kind of, what your volatility can look like, because it it was the best performing over the quarter. However, it also had the largest intra-quarter decline. It was down 13% at one point from the beginning of the quarter to very early in the quarter, but has rebounded all-time highs again, like we mentioned, up 22%. So it's a crazy back and forth kind of whipsawing action that I think is one of those situations where individuals or retail investors might not always stick it out. They might, we had talking to people and just seeing what is out there in the marketplace, a lot of people calling for sells, oh, get out here, we're going further down. And, if you don't get back in at an appropriate time, you can miss all of that gain. And so it's a really, tough market to maneuver, but it's just, kind of goes to show what, staying the course and focusing on the long term can get you, because it was looking pretty bad there for a minute, but now, back to fresh all-time highs.
Definitely. And we're talking our own book to some extent, but having a disciplined investment approach is huge in market environments like this, because it's not steady. It's extremely volatile. There's all sorts of different, signals trying to drive you, and noise as well. So there's signals and then there's noise. Noise being distractions, signal being things that actually require investment and portfolio change. We saw a lot of both of those things during the first half of the year, but taking a disciplined and prudent approach to, hey, when am I going to raise cash? How much is actually appropriate? Instead of, hey, get me out of the market, put me in the market. You've seen a lot of that over this last 3 months. You saw people totally exit the market or get close to exiting the market in early April. And now you've got this exuberance where people are trying to catch up to the market again. You're seeing all-time highs. People are ready to get back invested. And so just taking an in-between approach on those two categories. We were tactical with the way that we raised cash through this whole process and didn't oversell the portfolio, which allowed us to recover in these most recent months. And that's something that we can kind of touch on more later, but I think it's really important when you're talking about being a long-term investor is being able to, withstand those market downturns. And you mentioned technology. I think a couple of other sectors to call out on the opposite end of that spectrum were healthcare and energy, both for very, very different reasons. Typically healthcare is looked at this as a very conservative sector of the market. Well, a lot of that was driven by United Healthcare, among the biggest companies in the entire S&P 500, but a huge influence on the healthcare sector. It was down 40% over the last 3 months. Obviously huge underperformance. That was a lot of company-specific things, but it drove the whole sector over 3% lower, and it finished the quarter down, high single-digit range. Energy, on the other hand, was driven by lower oil prices. So we're going to talk about energy markets a little bit more later in the podcast, but you've got a combination of factors that really have been putting downward pressure on oil prices, and the sector's really gone with it. So something interesting, and there's a lot to dive into under the hood of that. There's a lot of companies and different industries in the energy sector, but overall it's driven by oil prices, and that's what happened this quarter at least.
Yeah, and then taking a look at other non-equities, going back to fixed income, is something I think is encouraging to see, is that the kind of inverse correlation with equities is back. That's something that was lost during this rate hiking campaign, because that's just kind of fundamentally how it's going to shake out. But over the quarter, the 10-year started around 4.2, 4.3, ended the quarter around 4.2, 4.3, but it hit an intra-quarter high of 4.6%. And that's a huge move on the 10-year. And so to see yields fluctuate as much as they have has really been kind of a unique thing. But having that inverse correlation back is at least, something that's nice on the day-to-day, have a little bit of a buffer from what your equities might be doing. And then the final part on, fixed income that I think is worth calling out is the 30-year. And so between the 10 and the 30-year, that's kind of really where your mortgage rates are determined. And the 30-year is still real high. It's and really the 30-year mortgage being at 6.8%, that's very prohibitive to the housing market. And so in order to see further improvement on inflation and especially those, shelter metrics, your owner's equivalent rent, your rents, it's going to take that number coming down. And so that's going to be a combination of both Fed action and just economic realities changing and, getting better. And so I think as we move forward in the year, that's something that, we've been watching for years now. But I think is going to be really important in the coming months and really the rest of the year to pay attention to.
Yeah, I mean, we've had quite a few podcasts talking about interest rates, Fed action, mortgage rates in the housing market, and how all of those, combine to influence, equity markets and other areas of investment. And to your point, I mean, yeah, housing remains frozen by those high mortgage rates. And it'll be interesting to see when they finally do come down because they have stayed elevated for quite some time now. There's always the anticipation of that changing, but we'll get more into that during our Fed section. Kind of the last piece on the look back over the previous quarter were commodities. I already mentioned oil prices, and we're going to talk about some of the geopolitics later in the episode. But gold was another one. So gold has been one of the best performing assets year to date and over the last 1 year period. I mean, it's just really risen to a significant extent. And a lot of that is because of the flight to safety factor that was driven by the tariff turmoil and other, geopolitical factors and just confusion on the world stage. People were saying, hey, I want something safe. I'm going to fly to gold. And so that drove a lot of that price action. The other part of that is the dollar depreciating. So as the dollar depreciates, it makes especially commodities rise in their relative value. It takes more dollars to buy that commodity all of a sudden because the dollar is worth less. And so that's what I want to get into currency markets because I think, beyond the impact that it had on something like gold's price, I think the move in the dollar was really interesting and had a big impact as far as how we're looking at things market-wise.
Yeah, it's been a huge quarter and really huge year for currency markets. The dollar weakened, it's weakened about 10% year to date, but it weakened 7% in Q2 alone, which is an incredible move that you just don't see in currency markets because they're generally fairly stable, at least with your major FX crosses on your US dollar, euro, US dollar, major economies. Those tend to be pretty stable. To see a 7% move in a quarter is exceptional. And this was driven by a lot of things. First two that most people think of that did contribute to it somehow is just expected reductions in future trade. Other countries in other countries hold U.S. dollars with which to transact. If you're buying something from a U.S. company, whether it's software, U.S. is a huge exporter of IP, software, services, that kind of stuff, you still are paying in U.S. dollars. Or, a lesser extent, U.S. goods that you're importing, you're also paying U.S. dollars on that. And so when you're not expecting to transact with these countries as much due to barriers such as tariffs, you're going to reduce your dollar holdings because you don't expect to need them so much. And then secondly, that a lot of people have been quoting, I haven't seen a whole lot of hard data to back this up, but again, it's a very fluid situation that makes it hard to tell, is just concerns about future U.S. growth. That's been something that's been floated around a lot as a potential consideration of if you think the European Union, for example, is going to do better economically relative to America, then the dollar might depreciate. European euro might appreciate, so you're going to allocate away from the U.S. dollar. But we saw some really interesting data. Again, like I said, it's kind of hard to find a lot of data around this because it's such a fast-moving, fluid situation and complex situation. There's so many inputs that go into this. But Victor, why don't you run us through that and kind of the latest, talk about what's going on here?
Yeah, I think it's interesting that you mentioned European markets because I think a lot of this is a self-fulfilling prophecy to some extent. It's saying, hey, we're worried about U.S. growth. We're not going to necessarily step away completely from the U.S. market, but maybe we're going to invest in European equities, and all of a sudden European stocks have outperformed the US year to date. I think another part of this is, and what plays into the US dollar devaluing or depreciating, is that a lot of institutional investors put on foreign exchange hedges over the quarter. And I don't want to get into the intricacies of this just for the sake of time and detail, but it wasn't necessarily so much. And I thought that was the interesting part of the data, was that it wasn't so much people stepping away from U.S. markets. Bids for U.S. equities and for U.S. treasuries remained relatively strong, and flows continued into U.S. assets. But it was a lot of anticipation of, hey, we're worried about, it's almost a, you're worried about being worried about something. You're worried about, because of what's going on in the US, or the potential for things to be disrupted by the tariff situation, for the US dollar to fall. Therefore, a lot of institutional investors put on US dollar hedges, which was basically you're insuring yourself against a downward drop in the US dollar. Well, in doing that, it creates downward pressure on the US dollar. So it's kind of a self-fulfilling prophecy that kind of led to a large extent of this move. I'm not going to say it was the entirety of the move in the US dollar, but a lot of it was simply the expectation that the US dollar could drop was what drove that downward. And I think you're talking about on a go-forward basis, it's going to be interesting to see what happens with U.S. dollar strength, because we have depreciated so far. I mean, we're at multi-year lows on the U.S. dollar. So going forward, it's going to take a few things, I think, to get us back to where we were at the beginning of the year, or at least closer to where we were.
Yeah, and I think, that's very similar to what I've said on the podcast before, that I think of kind of a lot when people are discussing recession is, if people expect a recession for long enough, you ultimately get a recession because people pull back on spending in anticipation of it, which in turn creates it. And so it's, it seems like a very similar thing with these FX hedges, is because there's so much anticipation of it or concern about it, you kind of, bring it upon yourself. And so I think, that kind of brings up, kind of the impetus for all of this, the tariff situation. And, really my view, and I think our view, is that as tariffs get either finalized, reduced, we get some trade deals, we return to really a more normal economic environment. I think we'll then see the U.S. dollar begin to normalize. I know using normal twice there, of course, normal situation, you get some normalization, but realistically, it's going to give people a better idea more of, where international economy stands and, how those trade patterns are going to evolve, which allows people to kind of take those insurance bets off and just kind of return to a more normal situation where U.S. dollar might be down a little bit for the year, but not 10%.
Well, and once you get these deals finalized, you're going to get a better idea of what the demand for U.S. dollars to transact will look like, because if you can kind of forecast out based off of trade deals how much more or less trade there's going to be given what the deal looks like. If you have super restrictive trade barriers in place via extremely high tariffs, well, then it's less likely that you're going to have, inter-country trade going on, more production domestically in the United States, more production, in foreign countries. They're going to stick to themselves to some extent. Demand for US dollars likely to drop because they just aren't transacting cross-border. But if you have easier, more light trade deals close to that 10% baseline that we'll get to in a little bit, then I think you're going to have that demand for US dollar rise. So I think that's where the interesting piece of that comes from. Now, getting into what is the alternative currency these days that is getting a lot of time in the headlines are cryptocurrencies. And I think it's been interesting, the anticipation going into this new administration here in the United States about what's going to happen with cryptos. We've seen some stablecoin action. A big part of what happened over the most recent quarter was the passing of the Genius Act, which essentially created regulation for stablecoins. Before, and this is true of the broader cryptocurrency space, but before this act, there wasn't a lot of regulation around these crypto assets. especially stable coins. And people were wondering, is it a threat to the U.S. dollar? Is it a threat to the U.S. government, the U.S. Treasury? And now you're starting to get some regulation around stablecoins in particular, which is going to lead to some interesting developments down the road. And I think we should do a podcast specifically on stablecoins and their implications for transacting, for trade, all those things. But it's at least starting to form a framework for how we can look at those from a regulatory perspective, which I think is a positive, certainly for that industry and for crypto assets. But it was a big development that we saw over the most recent quarter.
And I think it's really interesting because even if you aren't focused or interested in crypto as a concept like at all, which I've met many people who fall into that camp, is as stablecoin adoption grows, that drives demand for US dollars, which feeds back into the previous topic, because these stable coins generally based, the biggest ones, the most transacted ones are based on the US dollar. And so these are companies who are taking US dollars and issuing these tokens to be used as US dollars. And so it's more demand for dollars, which, leads back into the, some people might call the real economy or whatever, more tangible things. But it's still a very important, piece of the whole picture, whether you're interested in crypto or not. So that's, kind of one reason I think it's really important and why we keep coming back to crypto is because it's not a siloed off little piece of tech. It has implications for the broader macro economy that I think are very important to pay attention to.
Right. Like I said, definitely a forthcoming episode on all these things. I think I'd love to get into the weeds and all of it, so that would be pretty exciting. Last thing to mention on crypto, and we did a podcast on this already, but the U.S. government established a strategic cryptocurrency reserve. So, no net buying necessarily, but, the crypto that's been seized via, government interventions in illegal operations, going to hold on to that, not swap it for US dollars, slowly accumulating cryptocurrency, through those methods. Who knows what it'll look like in the future. And then you've got some states who are starting their own Bitcoin and cryptocurrency reserves. Still a lot of to be continued kind of mentality there as far as how it's going to impact the market, but something certainly very interesting in the crypto space.
Yeah, and so it wouldn't be a quarterly newsletter if we didn't address the Federal Reserve.
Yes,
and like
perennial favorite,
like it or not, the Fed has remained, at the forefront of the whole conversation for a reason. And there's kind of a mixed message of a lot happened, yet nothing happened all at the same time, because you entered the quarter with the summary of economic projections that the Fed comes out with once a quarter, forecasting 2 cuts at, this year at some point. You entered and exited this quarter with the same forward projection, 2 cuts this year, not yet, obviously, but still looking at those sometime in the future. But with a lot of underlying assumptions change, the tariff conversation has really become part of the Fed, which, Jerome Powell even used the T word in there at one of the early press conferences and has, very dramatically shifted away from believing this is going to be transitory inflation to being concerned in putting any Fed cutting on hold until they can see further inflation numbers with the concern that tariffs are going to drive inflation. And so, inflation has come down a lot. It's continued to come down across the quarter. And I think that's a really important part of this story. And so really it's the expectation of future increases in inflation that's really keeping the Fed on the sidelines for right now.
Right. It certainly seems like the Fed would be cutting right now if it weren't for the tariff question mark in markets and in regard to their dual mandate. And I think if we can continue to get a couple more months of low inflation, then they'll probably start cutting rates. They'll feel comfortable and say, hey, tariffs aren't having that big of an impact on inflation. And I think for a lot of reasons, I've mentioned this in our internal meetings before, but the way that tariff inflation is going to hit the market, it's going to increase the prices of some goods. But the thing is, the consumer wallet is relatively fixed unless there's big monetary stimulus or fiscal stimulus. And so if they are having to allocate more dollars to some of those goods that increase via tariffs, they're going to have fewer dollars to allocate to other areas of goods that they're purchasing, which means lower demand, which means economics 101, lower prices. And therefore, you're going to get kind of a balance when it comes to the official data. There are a little bit, greater details, a little minutia in there that will, alter that to some extent. But I think it's important to note, if you're talking about the data read through, then you're going to see a give and a take whenever it comes to tariff implications.
And I think that's a great point because, whenever you say that, I always immediately think of especially used car prices or even new car prices, which are a little more, dependent on the technology, the global economy, but especially for used car prices these are discretionary purchases most of the time. Sometimes stuff happens, you need a car. But the majority of the time, people are upgrading, people are getting something new or something different. But they'll happily push that purchase because they can't comfortably afford it if grocery prices are higher. I'm not saying that's a good thing for the economy, but on an inflation basis, those used car prices are going to come down because people are spending more elsewhere. So I think that's a really, interesting idea of that kind of give and take that I haven't really heard anywhere else, but really resonates.
Absolutely. And I think that's a great example. I think it's always important to note, too, that the Fed has this dual mandate. And I swear I've said this on a million podcasts at this point, probably at least a dozen, to be completely honest. But they have the inflation side of their mandate, and then they have the unemployment side of their mandate. And I think as long as they are cutting rates because of the inflation side of the mandate, then we're okay. That means inflation's come in, they feel comfortable, they're willing to cut rates. If we see unemployment tick up too high, that's going to be an issue for markets when it comes to investing, and equity prices will not react positively if we see big upticks in unemployment. And the worry there is that if we don't get rate cuts soon enough, the economy might degrade to some extent, which would cause unemployment to rise and force the Fed to cut rates. Right now, the way that you and I, kind of feel about it, it doesn't seem like we're in an environment where that's an issue, but we would like to see the Fed go ahead and get one, two, at least a couple of rate cuts on the board so that we can avoid a situation like that. Because I think the result is much worse if you wait too long to cut rates. You have a rise in unemployment, issues with the economy versus, hey, maybe inflation's slightly higher for a little bit longer.
And by a lot of metrics, inflation is really back in the range that the Fed is looking for. Your market-based PCE is 2.1% last month for the year, 2.1% for the last year. And there are a lot of other metrics. Some show higher inflation, some show lower, but predominantly they're, I think, all right at or within the 2 to 3% range, which is really a normal amount of inflation. We've all been focused on this 2% inflation number, but if we look back in time, between 2 and 3% inflation is not terribly uncommon. So I think that's a pretty normal spot for the country. And personally, I'd like to see the cuts a little bit sooner rather than later, just because we had it's one piece of data, but the ADP jobs report last week, down 33,000 jobs, net negative, when they were expecting a positive almost 100,000. And so, there's a lot of movement in those numbers, and, employment's notoriously fickle. So I'm not going to put too much stock into that, but, I would like to not see any more of those type of numbers and, just go ahead, take a little pressure off is really what we've been saying before the first round of rate cuts, is just take a little pressure off at the top, bring the rates down a little bit. And, if they're lowering in a normal environment for good reasons, I think a lot of that we'll see flow through to especially the smaller cap companies, because their, cost of borrowing is so much more important to them. Their debt servicing is a big concern for small companies who are, trying to invest as much as they can in growing this company, oftentimes high growth, but, fairly levered with floating rate debt. And so seeing, 25, 50 basis points taken off of that debt load can give those companies a lot more breathing room and a lot more comfort to continue investing and continue hiring as well.
And not to mention just the factor of the debt burden on those companies, but also the inflows that could happen in the market if you were to see a significant drop in rates. There's about $7.5 trillion in money market funds right now, which has historically risen just over time in general. But whenever you're getting 4% on your cash, money markets still look fairly attractive. If you were to get a few rate cuts, especially if we were to drop 1%, well, investors are going to start looking to public markets, private markets to deploy some of that cash because it's just not as attractive of an investment anymore. And so you're going to see a lot of that flow into stuff like small caps, mid caps, just broad area of the market, which I think will help drive equity prices. It'll help drive bond prices, which will in turn push yields lower. So I think that's certainly a factor to consider when you're talking about, hey, what are the implications of rate cuts on the horizon? What's it going to do to our investments?
Yeah, and then the final implication of this is the relief on the U.S. government's debt service costs. Because not only small companies, not only big companies, but the biggest company in the United States of America, the U.S. federal government, also has bills to pay, debt to service, and so a lot of the U.S. debt is actually short-term or rolling on a constant basis because you have, old 30-year bonds that might be maturing, old 10 years that might be maturing, as well as a steady supply of your T-bills and your just shorter-term notes that, are rolling on a consistent basis. And so this is why the administration is so concerned with cutting rates, is because that translates into hundreds of millions into the billions of dollars in interest costs just by ratcheting down our borrowing by 0.5%. And so with the U.S. being so much higher interest rate than really the rest of the developed world, I can kind of see the argument that, hey, we're kind of artificially costing ourselves a lot of money here. And so if we have the option to, obviously the Fed should pay attention to their mandate first and foremost, but there are real costs to dragging your feet in this kind of situation here.
Right. I don't think that we're going to get the 2 to 3% of cuts that Donald Trump might like us to get, but I think cutting earlier rather than later is important. And bringing that in summary of this Fed section, start cutting rates, make sure we're ahead of this economic situation, and as long as it's related to inflation, the rate cutting rather than unemployment, we're in a pretty good spot. Exactly. Now, moving on, the other major topic of the day, of the week, of the month, of the year is certainly trade deals. We've talked a lot about it before in our client commentary, in our podcasts, but I think it's important to provide an update of what's kind of happened over the last quarter and what's going forward. It's still very top of mind for companies. 427 of 500 S&P 500 companies mentioned tariffs on their most recent earnings call. So obviously an outsized portion are paying attention to what's going on with tariffs. We're quickly approaching now, and it's going to depend a lot, when we launch this podcast, but we're sitting just after the beginning of July at recording, and the deadline is July 9th for trade deals. And while most of the market and ourselves, we expect that deadline is going to get pushed if trade deals don't get done, there's still a lot of work to do. I mean, we've kind of created a trade framework with the United Kingdom, but that wasn't really too much of a trade issue to begin with because on the reciprocal tariff chart, they were at 10%. Our baseline is 10%, so they really didn't shift that much. They got, a slightly better deal than they had, before making the trade framework. We just announced today a Vietnam trade deal, and I think that's interesting. But other than those two, haven't really created any substantial trade deals. Of course, we did kind of renegotiate things with China to some extent, but really, as far as what we're looking at on the scorecard, we've got two-ish trade deals with dozens of countries waiting, ready, that we need to make trade deals with.
Yeah, and to your point about extending the deadline on these, I think we're seeing, at least what I've been hearing, is that countries who are in consistent communication with, like active negotiations, like the EU, perhaps Japan, they'll likely get more time to just suss out all of the finite details because they are such large trading partners. But a lot of the smaller countries, if there's not something on the books, they might not get an extension. And so that would be a concern of mine, is that, wake up on July 9th, July 10th, and then there's a fixed number and, hey, we'll get back to you when we get back to you kind of attitude on it. But to your point, countries are still subject to that 10% baseline tariff. You have your steel, aluminum, your autos on top of that. But that's really what we're hoping to get down to. I was encouraged by the UK trade deal of, okay, well, maybe 10% is our number. We'll get back to there, just trying to get a few different negotiating non-tariff points out of the way, like, exporting beef into the UK, for example, stuff like that. Okay, 10% is what you want, fine, and then you're trying to negotiate around the other stuff. With Vietnam, it was a little less encouraging. They have a 20% baseline tariff, and that can ratchet all the way up to 40% on transshipment. So these are things that are either shipped directly from China using Vietnam as an intermediary, or are predominantly made of Chinese imports. So, realistically for Vietnam, that's a 20% tariff. Still higher than I'd like to see, but, hopefully we can find a way to work around it. Most of the goods coming out of there are, they might be expensive over here, but on the tariff pricing basis, the value that's being shipped into the U.S., hopefully a lot lower. So hopefully that 20% doesn't actually make up, call it 20% of the final good that we're looking at. Maybe it's closer to 7% of the final good we're looking at. But that kind of remains to be seen there. And then really just the final point is we have Vietnam now, but that leaves a slew of huge economies, huge trading partners that we need new details with, new trade agreements with. I think Canada and Mexico kind of sit a little bit unique. They are our largest trading partners, and that's a very important relationship to maintain. USMCA covers a lot of stuff, but a lot of goods that are transacted don't fall under USMCA. And so that's either figuring out how to adapt USMCA to fit more goods, or, dealing with a separate trading policy. But the way it stands is really, concerning. I'd really like to see that get sussed out. And then finally, you have the EU, India, Japan, South Korea being the next really major players that are our trading partners that we would really like to see something get done with.
Yeah, Vietnam was on my list of top countries that we needed to get deals with, but it was certainly at the bottom or towards the bottom of that list. And like you said, not the most encouraging trade deal that we could have gotten, at least from our perspective, but it'll be interesting to see how the other countries
It's progress.
It is
Always
progress.
It's progress.
Now, I think it's worth noting the revenue side of this. We've talked a lot about government budget and concerns about spending. At least tariffs are bringing in some tax revenue. So we've had so far year to date about $75 billion of taxes generated from tariffs. And the estimation is between $150 billion and $250 billion by the end of the year. Of course, so much of that depends on what trade deals look like that are implemented over the next 6 months. But it's at least a revenue generator for the U.S. government, who at this period in time really needs that cash injection. I'm not a huge fan of redistributing dollars from the private markets to public, being the government. But in this case, it is helpful from that perspective, which is going to help as far as you're talking about your budget concerns and concerns around U.S. Treasuries being repaid. Now, let's get into the geopolitical factors. So we've seen a lot happening on the world stage beyond just trade, of course. You want to kind of lead us into that?
Yeah, so obviously the Russia-Ukraine war is still ongoing. And then we just saw what is hopefully an end to, war with Iran and Israel, and hopefully what sounds like soon a conclusion to Israel and Gaza. But, something that I think is important to look at here is, Russia-Ukraine is still ongoing, and Israel's war, especially with Iran, that expended a lot of munitions. That was fast, dubbed the 12-day war. However, the number of rockets being launched, and then, on the other end, the Patriot or other missile systems used to intercept those, that really depleted stocks. And it seemed like by the end of it, Israel was probably pretty low on these interceptor missiles. And most of these are manufactured by U.S. companies. And so this is going to create a huge demand and huge backlog in those companies. And, it's concerning from a geopolitical perspective, but also provides opportunity in that defense industry of, we need to, even if the wars are over, we need to replenish those stocks of munitions.
Yeah, and I think another part of that too is beyond just U.S. stockpiles, Israeli stockpiles, Ukrainian stockpiles, is that there's been pressure from the Trump administration to get NATO to up their defense spending. So looking for now 5% of GDP towards defense. I think a lot of these NATO countries are actually coming around to this idea because they're looking, hey, we're kind of on multiple sides now. We've got conflicts coming up, and here's an Iran who says they potentially have nuclear capabilities. We're pretty close to them. We're pretty close to Russia. So, it's probably important to kind of up that defense, especially when the U.S. says, hey, you can't just rely on us to make sure that you're defended from all sorts of threats in the world right now. And I think the tension in the Middle East, moving on from some of the defense contractors, we talked about this at the top of the episode, but it has really impacted oil prices. I mean, we were on a pretty steady downward trend in WTI and Brent crude year to date, except for quite the spike whenever the Israel-Iran conflict broke out, because obviously the Middle East, they're huge oil producers. And if you disrupt that oil supply, especially around Iran and the straits that, are huge oil shipment lanes, you can create much higher prices on oil. And so I think it was interesting to see how quickly that conflict de-escalated, though, and how quickly we were able to end that. Oil really just dropped right back down to the trading range that it was in kind of the mid-60s WTI range. And we really expect it to stay there because we've got a few factors driving that, and they're all providing downward pressure on oil prices, being OPEC plus production hikes. So OPEC plus is continuing to ramp their oil production. They've had it held back for so long, and they're just saying, hey, we're just not willing to, artificially cut production for much longer. They're ramping production. You've got the drill baby drill mentality here in the U.S. under the Trump administration. And then you've also got trade disruptions caused by all this tariff, turmoil that is reducing the demand for oil because trade is slowing down. So I think that three-headed dragon, if you will, is going to keep oil prices pretty suppressed, barring some other kind of black swan event or geopolitical conflict.
Yeah, and to that point, people were really concerned that Iran would close the Strait of Hormuz. But the issue with that is that at Iran's weakened state right now, they need the revenue that they can get by exporting oil, mainly to China. But, that's their really only economy at this point, is those oil exports. So they can't afford to close the strait because they need to use it too. And so that was, we kind of saw the spike in oil off those concerns that Israel would strike Iranian oil production. That didn't happen. And so we're kind of seeing this situation where there are all of these contingencies, all these worries out there that just aren't coming to fruition because everyone needs oil, needs that international trade. Countries like Iran need the money. China's happy to take cheap oil. So really none of these have like followed through. And so, following that big price spike, it's really come back in because, people were, again, hedging that oil price, expecting it to go higher and pushing it higher through doing that. And then all the worries died down and it came right back down.
That's right. Yeah, I think it's fascinating to see, and I kind of referenced this when I was talking about the sector performance, but within the energy sector, the divergence in different sub-industries. So for all of these reasons, we've really stayed away in our portfolios from upstream oil, just because we think there's too much pushing the price down. But there are other areas of energy markets that we're excited about. Nuclear, natural gas. Do you want to make any points on those two things?
Yeah, I mean, natural gas is really interesting. We wrote a decent amount of it in the newsletter, but really the idea being that, Europe, after the Russian-Ukraine war started, they started trying to diversify where they're getting their natural gas. It was mainly being piped in from Russia because it was convenient. Pipelines are cheap to operate. All of that good stuff, but they don't want to be supporting Russia's war efforts. So they started building LNG import facilities. Now that the freeze on the U.S. building LNG export facilities is gone, they can start doing that. They have been doing that, and we're now exporting more and more natural gas overseas where Europe really needs it, and it's trading at a lot higher price over there. So it's a really interesting dynamic right now that's really benefiting the U.S. Gas companies, whether that's upstream with the producers or downstream with the liquefaction and export terminals. That's a much more interesting story. And then nuclear, I feel like I talk about it a lot because I'm just really interested in it. And I think it's a great, baseload clean power system that it seems like the U.S. is really embracing once again. We just saw in New York, their governor, requested another, gigawatt of nuclear power be built over there. And outside of the reactors in Georgia, the U.S. hasn't really built much nuclear capability since the late 60s into the early mid 80s. And so a lot of that's fallen off, and we're kind of at the beginning of a new nuclear generation, whether that's small modular reactors or just traditional big power plants. New York, their specific case, they said they didn't really care. Just let's find something and build it because we need more electricity. This is a growing demand, and I want it to be clean and cost effective and efficient and reliable. And so there's been a lot of demand for that out there. And so I think we're seeing a lot, that's just a really interesting place for me right now.
Yeah, and I think as far as our investments, I think it's interesting to, like I said, divide your segment, the energy markets. So staying away from upstream oil, but leaning more into pipelines, whether that's natural gas oriented or otherwise. Also, focusing on LNG exports and just that whole ecosystem, as well as the nuclear operators and the nuclear fuel producers as well. I think a couple more important points that I want to make quickly before moving on in the geopolitical discussion is we mentioned defense contractors, but I think the future of warfare is certainly turning towards AI and cybersecurity. That's an area that we're invested in as far as the defense side of things being cybersecurity. So companies, whether it's companies or nations, they really need super sophisticated cybersecurity software in order to protect themselves from threats, because the battlefield's becoming more and more digitized as we go on. Not only does that mean drones, but that also means through the internet and our systems that we operate on every single day. If you don't have up-to-date and really sophisticated cybersecurity software, you're just not going to survive as a corporation or as a nation. And then Finally, I think semiconductors are interesting. Obviously, they play into the AI space as well, but I think the fact that the U.S. intervened in Iran gave us a little bit more confidence in the supply chain coming from Taiwan, because obviously the biggest concern about semiconductor chips is that because so many are sourced from the island of Taiwan, and there's this big threat overhang from China potentially invading, that you're going to see a lower valuation on a company like Taiwan Semiconductor because of that black swan risk that China invades. Well, I think the fact that the US intervened in Iran shows that they're willing to adopt kind of this peace through strength stance, which probably further dissuaded China to some extent from invading Taiwan. US showing, hey, we will come to the aid of our friends if it becomes necessary. So I think that at least gave me a little bit more confidence in investing in that semiconductor space.
Yeah, I think it was a really big, demonstration that, hey, even though the U.S. is striving for a peace through strength kind of approach to the world, sometimes peace through strength does require strength on occasion, and so that was, very reassuring for a lot of countries around the world, I think, including NATO too, because that NATO summit started off rocky and really by the end of it kind of smoothed out. It seemed, the U.S. reaffirmed that the article in NATO that, the Mutual Defense Pact and all of that stuff that people have been doubting or, throwing questions at without a whole lot of substance, but, there hadn't been a whole lot to refute it. So I thought this went a long way to doing that. So outside of, those, like kind of like you mentioned or touched on, is just the AI trade in general. AI megatrend is still running strong. I mean, it seems like a small bullet point on the broader list, but it's just been one of these things that's been running so fast for so long that you almost get numb to it, how explosive the growth has been, how much CapEx is charging beyond it. And I just want to make the point that that's not slowing down. People are still building data centers at breakneck speed. Companies are investing huge amounts into it every quarter. That number grows. So that's, I think something not to forget about, because it's just kind of the elephant in the room that we've been stuck with for so long. It's just been there, and then you just start paying attention to other things. It's still there.
Yeah, and I mean, it's having implications for multiple sectors of the economy, which is the most fascinating part about it. It's not just tech. It's not just the software companies or the NVIDIAs of the world providing the semiconductors to run the data centers. It's the industrials that are building the physical infrastructure, the power supply companies that could be in the utility space, or even the electricity generation fuel being natural gas companies in a lot of cases, or nuclear potentially. Then you've got the energy transmission companies, the power regulation companies, the heating and cooling, HVAC companies. You've got the companies building the server racks to go into the AI data centers. It's really fascinating the way that you have a lot of sectors coming together to provide what is technically tech.
It's a whole economy in and of itself.
Exactly. And I think I completely agree that megatrend is driving forward. We saw a hiccup back in February with the whole DeepSeek thing. Not saying that something like that's out of the realm of possibility, but all signs point to companies continuing to push CapEx in that direction, and that trend just, continuing with all the steam it's had over the last year, really.
Yeah. And so outside of individual sectors, I want to kind of cut it the other way and look at a couple alternatives that, we're not entirely equity investors. We've talked about, our approach to the 60-40 portfolio in the past, and a lot of that is, some kind of alternative, fixed income, whatever it may be. And something that, kind of we had renewed appreciation for, not that we ever slowed down on it, is structured notes. And so that became a staple of our portfolio, a couple of years ago at this point. And it's continued to be because, when we have sharp downturns like we did in April, these are have have served at least as such a good volatility dampener that they just kind of tick along. They did mark down slightly, but they continued to pay. They continued to mature at proper levels and pay out. And so we're running with depending on the note, but a lot of them, kind of our bread and butter, running at 10 to 12% per year kind of rates, and even when the market's down. And so that was just great to see that even if the equity portion of the portfolio is having a rough short term, hey, here's a less correlated part of the portfolio that continues to provide like consistent returns.
Right. I mean, if you have a 100-year time horizon, sure, you can throw it all into equities and be just fine. But for anyone who's managing their financial goals over short, medium, long-term basis, having these alternatives can provide a ton of value. Structured notes, I think, are one. It led to relatively pretty significant outperformance over the S&P for a large portion of the first half of the year, depending on the note. And I think that's why it's exciting to have structured notes, other kinds of alternatives, especially when you're talking about the more of the fixed income side of the argument, private credit being in with the right allocators in that space. Other lending's become interesting. Asset-backed lending is something that we paid a lot more attention to recently. I think private real estate is starting to have, somewhat of a renaissance here following the downturn that it experienced in 2022. And I think infrastructure is a big one because we've been talking about utilities, energy generation, something that hasn't really been exciting for a long period of time, but is paying regular dividends. It's a strong, stable, has a growing market. And that not only provides that kind of fixed income type return, but has a stable basis for investment and good fundamentals.
Well, I think a good point there is that the largest data center builder is a private company. It's QTS purchased by Blackstone, excuse me. And, but that you can only get through private funds, that kind of exposure. And so infrastructure funds sound really boring until you look at, some of what they may be invested in, depending on the fund, depending on what the mandate is. Some of those Blackstone funds that maybe have QTS in them, there's something you can't get elsewhere that people are searching for through other companies, other public companies.
Yeah, exactly. So I think those things complemented by a solid equity portfolio. And then, I think there is a lot of value in the professional management side. You and I, we spend every single day not only crafting what we believe is a good portfolio, but managing the volatility through periods like we've seen over the last 6 months, being prudent in our approach and not being overly reactive when markets swing, focusing on the signals and not the noise, I think has been so much of the approach that we've taken, and what has attributed a lot to our success over the last 6 months, over the last several years, is maintaining a disciplined approach to investing and helping our clients through periods like we've seen over the last quarter and so far this year.
Yeah, it's really exciting to just get back to that regularly scheduled programming, like we keep saying, and focus on fundamentals. That GARP investing that we've talked about before, growth at a reasonable price. You've different pockets of the markets get really inflated or really beaten down. And it really helps to, a lot of times you just have to ignore the price action and drill down, okay, the core of it, what am I buying? What is this company that I am buying a piece of? We always say it's a, market of stocks, not a stock market. It's a whole bunch of individual companies with individual attributes to them, and there's a lot to look for in different places of the markets. And I think that's why right now is such an interesting time to be an individual stock, individual equity allocator, is because there's so much opportunity out there that's not just buy the S&P 500.
Right. And it's a very overwhelming space if you're on your own. But as a team, we find it exciting because now we have more options than we ever have. And as far as, things that we can invest in, which is super exciting, new strategies, more interesting, private investments and alternatives. And I'm just excited to see where the thematic trends continue to take us so far this year, continue focusing on the things that you just mentioned. And I will make a note to our listeners that our Q3 newsletter is on our website at beckcapitalmanagement.com. If you want to give it a read, it has more detail than what we went through today. And if you made it all the way through this podcast to this point, we appreciate you listening. And Hunter, it's great walking through this with you today.
Yeah, and that's a wrap on another good quarter. I'll make sure that the newsletter is linked down below. So if you're curious about reading that, you can just click on that link and take you right to it. But thanks, Victor.
Sounds great.